The Retirement Cafe Podcast, episode 47, Investment Strategies and Managing Risk in a Turbulent Market.
Retired or thinking about retirement? You've come to the right place. Welcome to the Retirement Cafe Podcast. In each episode, we bring you an important conversation with insight, tips and knowledge, all designed to help you live a fulfilling and successful life in retirement. Here's your host, Chartered Financial Planner and Accredited Later Life Advisor, Justin King.
Welcome to the Retirement Cafe Podcast. This is Justin King, your host, and a very warm welcome. It is just me this week. I just thought I'd have a little chat to you about, what's going on in the world. I mean, a lot is going on, and we've got unbelievable political uncertainty. And what does this mean on your investment or your retirement savings? You know, it's certainly understandable if the economic uncertainty unfolding in the daily news has left you worrying or very concerned about what's coming next. Whether it's the UK or the US entering into a trade war with China, it's hard to deny that the prospect is currently causing considerable market turmoil. So regardless of how the coming weeks and months unfold, are you okay with gritting your teeth and keeping your carefully structured portfolio on track as planned? This probably doesn't surprise you, but that's exactly what we here at MFP Wealth Management would suggest. Unless, of course, new or different personal circumstances warrant revisiting your investments for reasons that have nothing to do with all the tea in China. That said, the news in the world, whether it's abroad or in the UK, is admittedly unsettling. And if you've got your doubts, you may be wondering whether you should now somehow shift your portfolio to higher ground until the coast seems clear. In other words, might these stressful times justify a measure of market timing? So I want to cover off 4 important reminders on the perils of trying to time the market at any time. It may offer brief relief, but market timing ultimately runs counter to your best strategies for building durable long-term wealth. So, number 1, market timing is undependable. Granted, it's almost certainly only a matter of time before we experience another recession. As such, it may periodically feel obvious that the next one is nearly here. But is it? It's possible, but market history has shown us time and time again that seemingly sure bets often end up being the losing ones instead. Even as recently as year-end 2018, when markets dropped almost overnight, many investors wondered whether to expect nothing but trouble in 2019. As we now know, that particular downturn ended up being a brief stumble rather than a lasting fall. Had you forgotten out then, you might still be sitting on the sidelines wondering when to get back in. The same could be said for any market timing trades you might be tempted to make today or any day. Number 2, so market timing odds are actually against you. Market timing is not only a stressful strategy, it's more likely to hurt than help your long-term returns. That's in part because average returns aren't the norm, volatility is. Over time and overall, markets have eventually gone up in alignment with the real wealth they generate. But they've almost always done so in frequent fits and starts, with some of the best returns immediately following some of the worst. If you try to avoid the downturns, you're essentially betting against the strong likelihood that the markets will eventually continue to climb upward, as they always have done before. You're betting against everything we know about expected market returns. Market timing is expensive. Whether or not a market timing gambit plays out in your favour, trading costs real money. And to add insult to injury, if you make sudden changes that aren't part of your larger investment plan, the extra costs generate no extra expectation that the trades will be in your best interest. If you decide to get out of positions that have enjoyed extensive growth, the tax consequences in taxable accounts could also be financially ruinous. Number 4, lastly, market timing is guided by instinct over evidence. As I've covered before, your brain excels at responding instantly or instinctively to real or perceived threats. When market risks rise, the same basic survival instincts flood your brain with chemicals that induce you to take immediate fight or flight action. If the markets were a natural forest fire, you would be wise to heed these instincts. But for investors, the real threats occur when your behavioural biases cause your emotions to run ahead of your rational resolve. We like to think one of the most important reasons you would hire a financial advisor is to help you avoid just these sorts of market timing perils. During just these sorts of tempting times, this is when you really need to take advice. Even if you do everything right in theory, we still cannot guarantee your success, but we are confident that sticking with your existing plans represents your best odds in an uncertain world. So, if you have your doubts, go and take advice. Go and find your financial advisor and have a conversation. It's our job, not to mention our moral and fiduciary imperative, to offer you our best advice across all of the market's moves. And while market timing may be illusory, we are here for you and ready to explore various real steps you can take to shore up your investment resolve, regardless of what lies ahead. I want to follow on with this with something called risk tolerance. You may, if you've taken advice from a financial advisor or you read the financial papers, etc., you'll get something talked about which is called risk tolerance. And it's the illusion and the practice of financial advice that each investor within their psychological makeup, they've got a fixed quantity of something called risk tolerance. Now, risk tolerance would have to be, if you could judge it, would have to be the percentage decline in a value of someone's portfolio, the investor's portfolio, which they could not financially or psychologically or both bear. The problem is that none of these assumptions which support the quantity theory of risk tolerance is true. Therefore, pandering to the illusion of risk tolerance, allowing it to become a critical variable in the discussions with our clients, sets everyone up to fail, probably at the worst possible moment. So, there are a number of flawed assumptions implicit in the concept of this thing called risk tolerance. The first one, I think, is that risk is synonymous with price decline. i.e., there is only one risk. This is not true. There are at least two risks to principal and to purchasing power. And the act of mitigating either one of these risks, we increase our exposure to the other. So if I construct a portfolio with the goal of limiting its potential for price decline, i.e. how much the thing can fall, I'm going to limit this to the same extent the opportunity for price for going up. That's to say I'm going to compress the potential return. The more I reduce the potential return, the more I expose it to the erosion of purchasing power. Because obviously, inflation continually erodes the value of your money. I point out to people again and again that if we've got inflation running at 2% and you're getting 1% on your building society account, then 12 months' time, you've got £99. You've got in real purchasing value of that money. That's huge. And if you keep doing that year on year, there is a huge risk to your capital that it's going to go down in value. That's a real risk of loss of purchasing power. So what do we do? What do we do, and how do we work it out? One of the really important, variables in this assessment of risk tolerance is percentage decline. I don't agree with this as well. I mean, it isn't. Since the end of World War II, the stock market has declined about 30% 1 year in 5. And to someone who would need to withdraw significant capital, say 2 years' time, this presents a vastly greater risk than it does to someone with no capital needs for 10 years. And it may be argued to the person who never plans to take any capital, but to just live on the income and the dividend stream coming from the capital, it represents no risk at all. And since the risk of holding equities declines very sharply over lengthening holding periods, then it is time which becomes the critical measurement of risk, rather than some arbitrary preset percentage price decline. Another way of looking at this is to distinguish again with time as the real variable between risk and volatility. To a 55-year-old couple whose investments must provide their income for 30 years or more, 30% price decline is an incident of volatility, but not of real risk. The other thing about risk tolerance is that it's fixed. Once you understand it isn't. Someone completes a risk assessment questionnaire, that's it from there onwards. I disagree. I think people's risk tolerances change continually depending on the noise in the market. If you think that the world's going to hell in a handcart, then you're going to feel much more scared about investing your money in the markets than if you think the economies of the world are booming. Of course, actually, if you were, the Warren Buffetts of this world, that you would probably be buying the shares when everyone else is selling. For every price decline, i.e. the temporary volatility of the market, there are other people out there buying those shares or equities at that moment in time. So when you're thinking of selling, also think about the person who's buying. When prices are plummeting, we should be considering maybe we should increase our risk tolerance to capture the values. But most investors will be running for the hills. At any given moment, an investor's own estimate of his or her risk tolerance will usually be an unconscious call on the current market, and therefore it's worse than useless. It just remains an uncomfortable fact of life in these times that our compliance departments and regulators want us to get some kind of handle on just how much tolerance for market ambiguity our clients can muster. But it's incumbent on us as advisors to be adult enough to see this effort for what it is and attempt to put the firms in a position where it can't be successfully sued for failing to gauge just how much adversity a client could take. So filling out essentially silly forms in order to quantify a will-o'-the-wisp like risk tolerance, it just isn't the way to do it. Rather, the answer is work with people who understand and explain to them how the markets work and keep them from getting surprised. Just grow up to the point where we understand that markets temporarily decline, but there is a permanent advancement. And if you're planning on a 20 to 30 year time horizon for your retirement, then get into the markets, have enough cash to cover those short-term needs, and just stay invested in a well-diversified global portfolio and keep your costs and taxes as low as you can. And that pretty much is probably the best advice I can give you for those listeners who don't actually sit with me and sit down in front of me and I don't manage their portfolios. That's the message that I'd like you to take out into the world when you're reviewing your own portfolios or sitting with your own advisors. I hope that's been useful. As I say, if there's anything that you'd like to follow up with me or call me or discuss with me, drop me a message. Thank you for listening. I do appreciate it. If you have found use of this podcast today, it's sponsored by MFP Wealth Management very kindly, and please do leave us a review on iTunes. They are very, very helpful to get the message out to more and more people. This is Justin King signing out. Here's to a successful retirement. Until next time, this is Justin King, helping you feel more informed in your retirement.
Thank you for listening to the Retirement Cafe podcast with Justin King. To find out more, you can find us online at theretirementcafe.co.uk.